things, but Robert Wood Johnson Foundation is backing this project. And we also have sponsorship on related topics from the Kellogg Foundation and the Sorensen Impact Foundation. So they help bring us these calls and also our coverage of all sorts of issues, including the reconstruction. So let me bring in. Actually, I guess we were gonna. Let me bring in Rudy, my colleague, Roodgally Senatus, first. Hi, Rudy. Rudy's taken the lead on all things kind of ownership. Let's introduce the guest, Rudy, very briefly, and then we'll jump in. So Damien Dwin, Lafayette Square. Thanks for joining, Damien, and just make sure you're off mute. But hello and welcome. You're still muted, but we'll come back.
I'm here. Hi, everybody.
There you go. Great. We always say there's always one who's gonna still be muted, and you got the prize, Damien. So Daniel Smith with Keepingly. Welcome, Daniel.
Thank you, David, for having me.
Charlie Sidoti from InnSure, who I just saw in Asheville, North Carolina, earlier this month, I guess. Yeah. Hi, Charlie.
Hi, thank you. Glad to be here.
And Andrea Levere from Capitalized Good. Welcome, Andrea. We just saw each other in Washington, D.C. this month. So
great. Thank you for inviting me, and I'm eager to begin.
Great. Just super brief preamble to set a little bit of context, and then we'll get to our terrific guests. We've been calling this a reconstruction, re with a colon, construction, and it taps a few, ticks a few boxes of mine. I've been fascinated by the historical reconstruction, and we, as readers of ImpactAlpha know, I've hit on those themes many times over the last few years. This updates it because it's really about building. And Rudy, we've been building this, the reconstruction. It's about building. We've been building a playbook for shared prosperity, and we've gotten a few dozen submissions. You and I rounded them up this week. We rounded them up last week. We'll keep rounding them up. Just tell us a little bit about that.
Yeah, can you guys hear me, by the way?
Yeah.
Yeah, David. I mean, these are strategies that are driving economic mobility for workers, preserving homeownership. We often hear a lot about strategies like down payment assistance to help first-time home buyers gain access to homeownership, but we've seen few strategies that actually helps them to maintain their home, to grow their equity wealth over time. And so we're seeing all of those strategies play out and form the first few pages of this playbook for shared prosperity. And now I'd love to turn it over to you, David, because you've been on the road over the past few weeks with the film Napoleon Wallace and the reconstruction of Black wealth, which ended with a Best Documentary win at the Boston International Film Festival. Tell us.
Oh, stop, Rudy. Oh, stop.
What was it like being on the road and being in Nashville and DC and Boston? And
well, that'll be a good segue. And thank you for that. And I think let's do two things, team, and maybe folks have the links handy. One is this playbook that we've been talking about. And there is literally a form you can fill out and add your plays, and we'll be bothering you and pestering you about that all through this call. And the second is now there's a link. If you haven't seen this film that Rudy mentioned, it's a 20-minute documentary with our contributing editor, Napoleon Wallace, who many of you know. And it centers on essentially a lot of these kinds of ideas around shared prosperity, particularly in North Carolina, where he is. But more broadly speaking, these place-based ecosystems of different kinds of capital, different kinds of support, different kinds of networks that can be a mechanism for shared uplift. And with that, let's dive in, because all these folks are authors of plays in the playbook for shared prosperity. So Damien, I'm delighted to have you. We've been tracking you and talking with you and enjoying our conversation for several years. And you have a very specific and targeted strategy around working class people, working class places. I just want to give you the floor to sort of lay out why that's compelling economically, financially, and also compelling socially.
We think working class people, working class places are the biggest domestic investment opportunity of our lifetime. We've got 50 million workers, a third of our workforce in America, employed by 175,000 companies. And the data shows that more than half of those workers live check to check. More than 2/3 of them do not enroll in company offered healthcare and retirement. And given tariffs, inflation, rising interest rates, and the lower cost of equity valuations in both public and private businesses, we have a moment where it's clear to me private credit can play a really important role in not only providing financing to small business, but also driving more efficiency and productivity from small business as a result of enrollment in healthcare, enrollment in company offered retirement, lower turnover, and seeing that the economic mobility of our working class is promoted in the private sector, in addition to all the good things that we know can happen legislatively here in my beloved Washington, D.C. So we are really excited to be capitalists, making money, lending to good growing middle market companies. But we'd be remiss in not pointing out there's a lot that can and should be done. More should be done with companies that are privately held, not by private equity, but by families, founders, entrepreneurs who think deeply about the long-term well-being of their employees. And so we like our role as an actor in the space who can profitably put capital into these good growing companies and also give them incentives to do the right thing by their workers, because we think it's a virtuous circle.
Well, let's stitch together that virtuous circle, and the incentives are literally lower interest rates from your borrowers who implement these policies. And is that because you think that they become actually a better credit risk when they do this set of interventions?
In part, but there's something more fundamental. The capital markets incentivize us to present data showing that we're doing the right thing for workers. We have 3 2030 goals at Lafayette Square. We've committed to create 100,000 working class jobs, invest 50% of our capital in working class places, and see that half of our portfolio companies adopt managerial assistance aimed at reducing turnover and increasing healthcare and retirement. As we do those 3 things, our fund enjoys a lower cost of capital. So in effect, the market is providing Lafayette Square with an incentive to do the right thing on the topics of economic mobility and improving outcomes for the working class. It just so happens that intersects with what is clearly in the best interest of these portfolio companies and the workers. In order to do it, of course, you need 3 tools. You have to have capital. You have to have a managerial assistance platform, which we do. We call it Worker Solutions. And you have to have great technology in order to geolocate where the businesses are and curate customized solutions for each business, because what you do in quick serve restaurants is different than what you do in software as a service, which is different than what you do in construction. And what you do in North Carolina is not what you would do in Arizona or Maine. We're a national lender. We're fortunate to be licensed by the Small Business Administration and to be regulated by the Securities and Exchange Commission. So all this data we share in our regulatory filings, but it starts and stops with incentives. And it turns out the incentives we receive as a firm from the capital markets, which impacts our cost of capital, allows us to provide yet another incentive to our portfolio companies to impact their cost of capital. And the tie that binds is, what are we doing for working class people? What are we doing for working class places? What data capture do we have? And how do you make money? And I'm really excited to say this is a profitable model, and it's a scalable model, but it does require having puts and takes on both sides. If we didn't have an incentive on our funding, it would be challenging for us to offer an incentive on our investments. That we have everyone, preaching from the same hymnal is a really big deal, because these three goals, I think, are not only laudable, I think they're pro-America, they're clearly good for the working class, but I think this is the next chapter of capitalism itself.
And just to be clear, you are I want everybody to understand the sort of alpha and impact thesis as we would like to think about it, which is the incentives that you get from your lenders and you make to your borrowers creates a virtuous circle that makes the return actually better. So people sometimes think that these worker solutions or these extra benefits are a cost burden that would lower the return. You're making the opposite case. So just make sure everybody understands that.
You said it well. But what we found in our journey as Lafayette Square is repetition is a necessary ingredient to this, because people don't believe it until they can see it. And it's one thing to say it in the abstract. It's something else when you have 50 portfolio companies, or 9 figures or 10 figures invested. Now all of a sudden people say, wait a minute, money's moving, and what are the returns there? What are the outcomes for the businesses? How are they performing? How are they growing? How does that work across cycles? I think the important thing is we run toward Washington and we run toward regulation. And I get made fun of by my dear friends when I encourage them to read my 10K or look at my 8K or my 10Q. And they say, well, why would you ask me to read? Like, what are you talking about? I think these documents are really important because we want to show it in the light, how it works, and let people judge for themselves over time.
You are the rare fund that loves to file SEC regulatory filings, which we appreciate, because it is a kind of transparency and openness that is rare. And just to close up, you provide private credit, and you mentioned in places, and I know Rudy's written up 535 Insights, and you have a whole data back in it, which you mentioned, to get credit to places where there's a lack of credit or lack of access to credit or lack of access to appropriate credit. And why, if it's such a good investment, why is there a gap, and how can you get some, I think you've talked about, get some competition going for that market?
Capital formation and capitalism itself tends to flow toward 5 states: California, Texas, Florida, New York, and Illinois. Suck a lot of air out of the room. And it gets worse when you think about the ease of doing big transactions as opposed to small transactions. The challenge, particularly now that we have tariffs and inflation and some of the topics of the day, it's very clear that a third of our workers are employed by companies with less than $1 billion in revenue. Whether they're manufacturing or service companies, doesn't matter. Those companies are not going to be good targets for private equity doing huge transactions because they're inherently smaller. And whether you're doing 10 million, 20 million, 50 million EBITDA, those numbers start to feel small to buyout funds with $10 billion or $5 billion. So I really like focusing on the numbers. 175,000 companies with revenue less than $1 billion tells you there's a huge addressable market, so trillions of dollars of capital. But local banks are not serving those companies to their satisfaction, and their cost of capital is going up in this moment. Finding a way to meet them where they are for their capital needs is a big topic. Simultaneously, these same companies are dealing with turnover and labor challenges that are a generational challenge. And having a private credit firm who understands both dynamics is really powerful. So we're helping them with not only getting funding in the tens or hundreds of millions of dollars, as the case may be, but we're also helping them reduce turnover and increase healthcare and retirement things that really matter to folks who care about their community and care about serving their customers well.
Terrific. So getting capital to companies in places that can create good jobs and helping them ride the uplift of their employees and their communities. And thanks, Damien. Stick around, and let's move though to Daniel Smith Keepingly, who I've met only recently, but has but again filled answered a question that we've been talking about, which is home preservation. Home ownership preservation as a key lever, and not just first-time home buyers getting into the market, but preserving the ownership that folks do have. So welcome, Daniel, and maybe just tell us what the problem is on that front.
So when we look at the market and we look at what homeowners go through, we think, especially at the top end, and in the current environment where so much of the conversation has been a supply conversation, we are short 5 million homes, etc., depending on what numbers you listen to. You really would think that it starts there. But when you really come further into the funnel and you look at the experience, or what I call the homeowner journey, you start realizing, okay, for most of us, our home is our most important asset, 99% of your population. And so when you start drilling down further into it, you start asking yourself, what does the home ownership journey look like? What does this process look like? And how do we ensure that these persons who, for them, this is their biggest asset, how do you give them, or how do they really think about their home as an asset? Because it's not an asset unless it puts money into your pocket. And for most of us, we think about our home in a very philosophical manner, where we think, well, I become a homeowner and then automatically, because again, one of the historic things that we said, the pathway to wealth generation is, home ownership, or we've, as a society, we've said a lot of, become a homeowner and, get married, buy a house, etc. We all have these very philosophical, ideological things that we've been taught, but it doesn't necessarily tell you how to manage that home, how to think about the fact that your roof may need to be changed in 20 years, or the fact that as a country, we spend $50 to $60 billion annually on emergency repairs. And so when you start extracting some of those data pieces out, and you realize that a large part of the 50 to 60 billion that we spend in emergency repairs is due to not having the toolkit to be able to preserve or to actually understand what needs to be done in the preservation of the home, you realize that's a massive problem. And so we are looking at, how do we help solve that problem by giving you the tools to be able to make those decisions.
Yeah. And I'd love to jump in here, Daniel, because your solution I find very interesting. You're building a digital platform
Yes.
that includes this maintenance checklist for things like when to fix your roof, when to replace your refrigerator, where your documents goes. How does that help homeowners to manage their home, especially considering that, like you said, it's their most important asset?
It starts at the beginning, Rudy. When you get a home, and I don't know how many people in this call can say, I know exactly where my closing documents are. I was in DC yesterday having this same conversation with some of the founders of tech, and when they thought about it, most of us realized that you understanding where your closing documents are, it's in a folder somewhere, or the file drawer or something, or you may know it's in a Google Drive, but trying to tell me how quickly can I produce those documents so I know exactly where they are is a challenge for most of us. And so it starts at that point, but further on down the your home ownership journey, you start realizing things 6 months in, a year in. It's really important to understand what is going on. So whether or not you've changed your refrigerator or you've had an emergency repair to do, what is the documentation behind that? Do you understand your exact expenses around your home, whether it's your electricity or your water, etc.? And so what we are doing is really starting you from point zero with your documentation and then helping you along the journey with like the checklist that we've built, which is seasonally adjusted, which really helps you to think about, those different instances and use cases. I have had a lot of conversations with person who said, I've been a homeowner for 5 years and I didn't know that I had to change my filters. And I'm in some of these conversations in shock, because for me, this is your most important asset, and you don't even know that there are filters in your AC and stuff like that. And so, what impact does that have in terms of your maintenance cost, or the fact that your AC may blow and stuff like that? That's supposed to be changed every 3 months. So you've gone 5 years and you've never changed it. How does it impact your AC and that appliance or that equipment that is constantly running, and the cost goes up. So those are, the use cases and the instances where we do believe that, it is really important in this asset class, even in instances where, God forbid, you have a parent that dies and you need to understand, okay, what has happened in this home? Do I sell it, especially for kids who live, 5,000 miles away? How are they able to manage that asset? And so there are so many different points of view. I've had, some of those really relevant conversations where somebody said, my spouse tackled all of the details around that. I knew nothing. And so we realized that it's really important to be able to give persons those kinds of details and toolkits so that they can manage the home as an asset. It's not just the place where you feel good at. It's the place where, hey, you need to be able to take out the equity. You need to be able to take out, a loan, send your kids to school, etc. We need to be thinking of your home like that.
And Daniel, we know homeowners across the country are dealing with, high property taxes and maintenance costs. Is there a bigger play here for Keepingly? And I'm curious, how does your solution help them to mitigate the risks of those high costs and maintaining their homes?
Definitely. The way that we evaluated and have looked at it, ultimately back to, some of the stuff Damien was saying, you're living in a really high inflation environment. You're living, government needs to get taxes. Whether we like it or not, climate change really does have an impact. So for persons like me who live in Florida, you've seen your insurance costs go up like 5 times in the past, 8 years, etc. Understanding what does that do. But again, if I am an insurance company, I need to understand exactly how your home has been maintained so that now I can really give you optionalities in terms of being able to help you reduce that cost if there's cost that can be reduced, but also really being able to give you the toolkit. So for instance, Florida example, a hurricane is approaching, help me understand exactly what I should be doing, because these are the real life instances and occurrences. If I look at like the California wildfires that happened in January, a lot of stories coming out of that was that people didn't know, where their insurance documents were. They didn't understand their coverage. They didn't know closing document, because again, in a lot of these instances, these items would have been in the property themselves. So you don't, in a lot of instances, you don't necessarily have the details around what's going on, because while it's your most important asset, this isn't what a lot of us were trained to do. And so we don't necessarily pull out some of, we're looking at, okay, what are the deductibles? What am I going to pay for? Do I just want the lowest cost on insurance versus, okay, do I have comprehensive insurance for my most important asset? And so those are a lot of the things that I think that, the ecosystem will benefit from being able to actually understand and being able to help make better decisioning. And for us at Keepingly, it's really about the transparency in the asset class. We do believe that either we are facing one of two problems, either an overvaluation or undervaluation. But if we go back to a lot of what has happened in like 2008, etc., where homes were sold underwater and nobody understood what was the exact, viability of some of these properties, I do think that we may have lost out on some of the valuations just because of the way things were done. And so that would help, in a lot of instances, to be able to create more transparency and help really create better decisioning around what is going on in the asset class.
Terrific, Daniel. And I was just going to jump in because the insurance example is a perfect segue to Charlie Sidoti at InnSure. And so they're kind of two parts of part of the same equation, because insurance costs, Charlie, as I understand, and we see it here in California, are going through the roof, and accessibility is declining. And in places like Asheville, where we met, and out here in California, in LA and elsewhere, under insurance. So you've been thinking about sort of how to use insurance as a lever for community wealth building, as opposed to community losses, which is where a lot of these disasters have obviously headed.
Yeah, and Daniel talked about a lot of the triggers and the importance of insurance. It was awesome listening to you. Those are a lot of the things we care about, for sure. But doing all those things doesn't necessarily guarantee the capture of the value. And so what we've been working on is things that say, hey, if you're doing all the things right, and at a community level, and the individuals within the community that are investing in reducing losses as much as they can, and understanding their insurance landscape, there are ways to leverage the market to capture that value, including things like we like to talk about community embedded insurance, which is leveraging a group purchase around a group or community of individuals, which could be driven by, municipal governments or homeowners associations, or just people kind of getting together to say, hey, we are doing these things. We are maintaining the homes. We are maybe building to higher levels of standards, but we want to capture the value of that, and we will kind of procure together to do that. So there are a lot of ways to, what we like to say is integrate insurability planning into economic development planning and resilience planning, and bring all these kind of things together to make communities both financially and physically resilient.
Terrific. And just to underline the point, what you're describing is a set of interventions that create value that you can get paid for, which was what Damien was describing in a different context, in a workplace or in a business. And in the community embedded insurance, you're saying if the community as a whole does things like fire prevention, or flood prevention, or flood or resiliency planning of all sorts, they can get paid for it. We just had an example in the brief of a homeowners association in the Tahoe area here that negotiated such as a collective group. So is that the future of collective bargaining, as it were, for
Yeah,
insurance?
I think it really is, and we're working with Cal Fire is investing in homes in a number of communities. We're working with 5 communities out in California that are investing in defensible space and home hardening, and even kind of landscape level mitigation of wildfire risk. But it, like I said, it doesn't automatically translate to the industry, either making insurance more affordable, accessible. In some cases, it does a little bit. In some cases, it doesn't. And the onus is really on the community leaders and the homeowners to say, hey, we did the hard work. We kind of bore the cost of the investment in these things. We need to capture that value. And sometimes you can leverage it just from the existing industry, but then there's also additional things that communities can do, which are really going back to the way insurance industry kind of evolved. It started as mutuals, where people get together to pool risk and share risk and protect themselves. Like right now, it is most risk capital in insurance comes out of places like Munich and Switzerland and London, and they are often disconnected to what is going on at the local community. And what we're saying is, you need the pools of risk capital to be large enough to spread risk, but you still need them small enough to be connected to the local communities, what's happening in the local community. So we are promoting this concept that really follows the way kind of community development banks grew. There's 1,500 community development banks in the United States that are often mission driven, closely connected to the communities. That's what's missing in insurance. Insurance often ratchets up the price based on broad trends related to increasing risk, such as climate change, but they are not super effective at capturing kind of local investments that maybe aren't typical or innovative at reducing risk. And what we need is, the mechanisms to finance these risks and transfer these risks to capture both the increases, but also the reductions made by efforts at the community level.
People on the call and readers of Impact Alpha know about community development financial institutions, or CDFIs, and you've been talking to me about community development reinsurance institutions, or CDRIs.
Yeah.
And that, I think, is what you're talking about. And just sort of stitch that back, and then we'll move to Andrea, but just stitch that back to how, better coverage, more access to coverage, the right kind of coverage, as you said, but also affordable, and what is as a sort of wealth building or wealth preservation tool for communities.
Yeah, right now about 50% or more of catastrophe risk is uninsured, which is a lot. If you think about health insurance, before kind of the Affordable Care Act, it got to 15% of people being uninsured before, people, the Affordable Care Act kind of came through. 50% is a really large number. And when a catastrophe happens, it doesn't even need to be a big, like LA, massive fire. Like small storms in those communities that Damien talked about that are, working people in working class places, they can get a tremendous amount of wealth can be wiped out from very small events that occur when the protection gap is at 50%. And so what we're trying to do is really think about how is risk financing done in a way that increases or closes the protection gap, but has more people have insurance. So when like small catastrophes that affect a lot of people, and in people with low wealth, when they have a little bit of wealth gets wiped out, it's much more catastrophic potentially than more affluent communities. So we're trying to kind of close that protection gap, and a lot of that gets to how you distribute the group purchase, community embedded, the types of products like micro insurance can really kind of prevent the destruction of wealth. During Katrina, people didn't leave because it was a $200 bill to stay at a hotel, and the evacuation. Why should I leave? I can't afford $200. So there's a lot of opportunities to create insurance products that cater to those communities that need different types of insurance distributed in different ways.
Terrific. Each one of those innovations is a play in the playbook. So we'll be collecting those. And Andrea, you've been at this wealth building and income building, financial security for a long time at Prosperity Now, and then now at Capitalized Good. But just maybe give us the broad strokes of how you see this wealth building agenda, right now, including in the current environment, as people like to say euphemistically about what's happening across the country.
Well, I'd begin with 2 points, which is one of the common themes of all our speakers is the kind of core principle of product design, which is nothing about us without us. And how do we build on that knowledge? One of the issues that we confronted and most proud of at Prosperity Now was understanding the interconnection between income and wealth, and understanding that across the continuum. And we created a new metric called liquid asset poverty that some of you may be familiar with, which basically measured the ability of a household to exist at the poverty level for 3 months if their main source of income was disrupted. And what this shows is the fact that everybody needs some emergency savings or needs some kind of financial product like that to be able to manage the ups and downs, just as Charlie was talking about, in a broader way on their communities. And so when we think about what are the most effective products that help to build wealth, they have 2 core elements. One is really readiness. Where is someone along that pathway where you are providing a product that meets their needs today, but also helps to build for the future? And then the second is this question of integration. How do you think about products that work together to create more than each product by itself? And to that, I want to build on Daniel. One of the things we saw in our promotion of home ownership, and one of our main products was individual development accounts, match savings for asset building, is that the worst thing you could do is help someone buy their first house and not figure out how you align that with a savings account that could deal with the emergencies that came along. So we identified a product that matched a savings account with the mortgage. So you actually paid your mortgage and put some into the savings account simultaneously. You never had to think about it again. So if the furnace went down, it didn't suddenly undo you and really affect your ability to pay your mortgage or other things. So how do we continue to think creatively about how we integrate products in ways that are as user-friendly as possible, so we're safeguarding income and building wealth?
This may be too broad, and you can take it down to earth, please. But if you take what you just described, you take what Damien described, what Daniel and Charlie are talking about, is exactly the uplift that Damien sketched, which is that if you bring people together, you just said it, if you integrate the design of this set of products, each one being a play, that there's a general uplift, broadly speaking, in the economy of communities, and obviously then down to families and individuals as well. So there is an agenda here that lifts both families and communities. Is there not?
Absolutely. And what I'll say, having been at this for 4 decades, what we can accomplish with the technology we have today is an exponentially different picture than what we could do when we started. And, one of the issues that we look at is how do we do this equitably across race, right? At the same time, how do we broaden those categories so we have benefits that accrue to everyone, but we don't forget the specific barriers that exist because of race? So, for example, back to the account that marries with an emergency savings, that is a universal benefit. But yet, we see the fact that the appraised value of a house, the exact same house, will vary dramatically between a white neighborhood and a neighborhood of color. So how do we build in additional protections or incentives to address that barrier to wealth building? At the same time, we create products with a broader impact that can bring together communities in their wonderful diversity.
I want to give you a chance to tell us about your newest project.
Thank you.
And then I want to open it up, and I want the audience and the participants to start asking questions, asking questions, and then we'll also just have a broad discussion. But you've made the point to me, nonprofits are businesses too. Sometimes they get disparaged as something else, but you've been helping them get to operate more like businesses. So tell us about Capitalized Good as a lever for change.
So basically, a nonprofit is a tax-exempt business, right? And all the rules we understand about finance for for-profit businesses exist for nonprofit businesses, but even more because they're solving problems that the market can't solve. So you would never start a for-profit business or venture without equity. And having spent 10 years financing small businesses, I know that the major reason small businesses fail is they don't have enough startup equity to absorb the losses that happen until they reach break even and then grow. This is exactly the same for nonprofit or tax-exempt businesses, except they're not allowed to lose money, right? Otherwise, we won't fund them in the right way. So our whole goal is how do we build on the core principle of finance, which is financial strength depends on matching your sources and uses of funds. And for mission-driven organizations with long systems change goals, they need the flexible, long-term capital necessary to thrive, to build the the organizations they need, from human capital to infrastructure and elsewhere, but also to do the innovation and strategy that is essential to success. Why is this more important than ever? One of the things we've been able to see with tax-exempt businesses that had significant amounts of enterprise capital or net assets is they were able to make it through COVID at dramatically different rates than those organizations without those net assets. And particularly those organizations that are critical on a community basis. As we face this moment, we need this exact same kind of funding that will provide these organizations with the stability they need to weather the changes, the strategic changes they need to make to adapt to a new environment, and to continue to play the critical community building roles that they play.
Great, great. So let's open it up. Broadly speaking, I loved how I think the wonky term that you were talking about, which I love, is targeted universalism. And you talked about product design and how important that is, and solving, for the real problems for some folks will also solve the broad problems for a lot of folks. And maybe let's there's a few questions now coming in, and let's just take them in the order they came in. I think this was to you, Damien. How are you overcoming the inherent bias in finance to invest in underserved communities? So a lot of the things Andrea mentioned, and Charlie and Daniel as well. There's appraisal risks and other things. Businesses get valued differently. How does that show up, and how do you overcome that in your business?
I don't think there's misalignment. I'm a conservative underwriter, so I want to invest where I'm going to get my money back. This is not, to the point about not-for-profits and charity, something we're doing for a tax write-off. We have to get back our principal plus a return, which means we're looking for businesses that are growing, audited, and can withstand that level of scrutiny. And I like the addressable market. 175,000 companies, it's a lot of businesses to choose from. When you lift the hood in private credit, turns out less than 10,000 companies are currently receiving capital from the most regulated private credit managers. So there's very little penetration. By the way, of that less than 10,000, 90% of those companies are private equity owned and controlled. So there's a lot of wood to chop in terms of just bringing a conservative, thoughtful credit box to the middle market. And I think we can have our cake and eat it too. Smart investments and things that repay, where we also do the right thing by our workers and center their well-being as part of our underwriting, and report all of the data transparently for public consumption, whether people choose to pay attention or not. I think success is making a lot of money investing in these businesses and producing market-leading data to prove that working class people and working class places were better off as a result of the capital and the services. But that theory of change is one of the things that separates Lafayette Square. We openly say capital plus services makes impact. But you can only prove that theory if you have a vibrant financial business, like you have a balance sheet, and you have an ecosystem of services that are useful and that portfolio companies volunteer to take on. We're not forcing people to do this. We use incentives and data. And it turns out companies want to do the right thing. They just don't often have a financier who can help.
I love the data part, and also, you say there's a large addressable market. So I would guess that over time, the track record that you establish might factor into other folks' calculations of who might be lendable and whatnot. So because it seems like you're saying that there are a whole raft of companies that are credit worthy that are not now getting access to capital, and you're able to tap that. I assume it's a competitive advantage of yours to be able to tap that market.
That is true. It is also true, as you say, and I'm paraphrasing here, the brutal competition that exists in our capitalist system means whoever's getting the most attention and the most money will have fast followers. So success is the most attractive thing in America, even more than the comeback story. It's success and proving that we can win investing in working class people and working class places is the whole goal. The more we shine a light on it and make money doing it and share data, we will bring other people into the arena. And all of a sudden, over time, a rising tide lifts all boats in terms of these working class people and places intersecting with the middle market.
There's now questions are coming, so that's nice. This is a question to Charlie, but it's I think also an incentive, if I understand it, an incentive kind of question. So more broadly, did InnSure try to design test a kind of hybrid tools to reduce insurance premium? There's an example that allowed partners to reduce the loan interest to 0% in rural communities. You can take that, Charlie. I think it's a question of whether you really can save folks money with the tools you're talking about.
We do think that there's we talk a lot about insurance and insurance markets, but we do think it is broader than that. It's I think it was Andrea that said, how do all these tools kind of work together?
Yes.
Is crucial, and which is why we think that kind of this insurability planning needs to be integrated with other types of planning. And there is just fixing the pure insurance markets won't probably happen completely and won't be fast enough for sure. So we're looking at hybrid approaches for sure.
Good. This one is broad, and so you can each take it. I think it's more of a sort of framing question or a language question, which is asset framing, which is, we try to do that at ImpactAlpha and talk about solutions and much more than problems. But it's how do you consider this this kind of asset framing in product development and marketing? And then to be provocative, does share the wealth, which I've been using, come across as asset framing, or is that have a sort of more negative spin? I imagine, Andrea, you might have some thoughts on framing this up as a positive or as an asset.
Well, one interesting point about this is starting with the language that people truly understand and then taking them in the direction that you want. So when Prosperity now was first created as the Corporation for Enterprise Development in 1979, the phrase wealth inequality wasn't in anybody's language, right? So how did we, over the course of 30 years, make that a phrase that people understood and then expand that to understand the racial wealth divide? So
the wealth inequality is the negative framing. What's the shared prosperity or something is the positive?
Wealth equality.
Wealth equality, yeah.
Right. Wealth equality and opportunity. So to me, it's a both and. Share the wealth means let's build the wealth for everyone. And how do we do that? And how do we create policies and institutions that do that effectively? But at the same time, we need to say, how do we invest explicitly, as everybody on this call is doing, in those communities that do not have their fair share? And how do we make that happen in a more equitable fashion?
One of the things that we like is a notion, and I'll hat tip to Delilah Rothenberg about the pre-distribution initiative and pre-distribution as opposed to redistribution, because share the wealth usually, I think, immediately goes to tax the rich. And they're not to go into that discussion right now, but the other frame that is more of an ownership economy frame is give everybody a stake as assets appreciate, whether those be financial assets or as Charlie and Daniel have been talking about, home ownership assets, Damien, in businesses. And so if folks have a stake as assets get richer, then we can share the wealth on the front end and sort of all get rich together, as opposed to thinking of it as some kind of zero-sum game where somebody has to pay up.
And I just want to add one quick point, which goes to what Damien's doing, is that as we were scaling these asset building strategies, it all came down to trust. And where an employer is trusted is where we had the most success in expanding savings products and other things. And where employers weren't, we had the opposite.
Damien, the next question was to you, and it goes to how are you seeing the age of business owners, the so-called silver tsunami, retiring boomers in a sense, affect your market? One of the things that we've obviously been talking a lot about is those owners sometimes selling to their own employees in an ownership plan, an ESOP or other kind of ownership structure. How are you seeing it?
We're big fans of ESOPs. We promote ESOPs through our institute, the Lafayette Square Institute. So there's some new legislation in that vein. The silver tsunami is real. It's scary and in some instances very sad that entrepreneurs create amazing businesses and their kids have no interest. And I'm a father of four, so I see it up close and personal. We need, particularly in this moment, to really hold up our privately held businesses without private equity dollars who are looking for a succession plan that provides dignity to their employees and leaves something behind to their community. And the private sector has a role to play in that. Commercial banks are doing their best to be helpful, but they're ill-equipped to get all the way there. I think private credit can play a meaningful role. But it's tough. There's some challenges here. And of course, we are in a fluid policy environment where tax incentives are changing. But fundamentally, we have a lot of entrepreneurs who are aging out and don't have a good succession plan. And their employees look interesting and attractive, but need help with the financing to buy them out.
Yeah. Yeah. All I can say is, Damien, I'd love to chat with your children and tell them what an opportunity they might be missing if they don't take over the business. But let's give everybody a chance for a sort of final thought. And we're at 5 minutes or 4 minutes, so you have a minute each. But if you want to take two, I think that's fine. And maybe start with you, Daniel, and then we'll end back with you, Damien.
Oh, thank you. I think that a lot of what Andrea really said, and I loved the framing of how they did it over at Prosperity Now in terms of really helping persons to understand, okay, this is your principal and interest, but also this is your savings. I think that there has been such an overemphasis on putting people in homes a lot, especially over the last 5-6 years, that we have forgotten to actually help to think about, okay, what happens when they get into these homes. And when we look at the numbers of foreclosures that, can rise and fall, depending on what is going on. But when we also look at what is going on in the macro economy, inflation, etc., we really need to be thinking through as a society how we really help these homeowners, because, when the bottom starts going up from under these homeowners, then the whole economy suffers. And so really putting tools and systems in place, putting in also what Charlie talked about from an insurance standpoint. I love the solutions that they're building because, yes, I agree that community solutions are absolutely necessary, and we have to be thinking about things in different ways. So for me, ultimately, I think that collaboratively, all of these solutions, especially for the homeowners who don't understand, who don't know, who, their parents weren't homeowners and they didn't have these kind of educational tools to be able to help them. We are really looking at toward the future with, the possibilities being bright of how do we really create the change that we want to see, and how do we really give persons the tools to be able to do these things and create better impact and create a generational wealth, not only in philosophical terms, but really where they can actually see it and really it can really impact their lives.
Terrific. Charlie?
Yeah, I'll just add, I mean, I love all that. And I would just add that around the framing, we like to think of things as, there are beyond just kind of who has the wealth and who doesn't. There are lots of other intangible kind of mutual interests that are critically important for the people that maybe have more capital. But if half the community gets wiped out for whatever reason, it's going to cascade through everybody. So it is it is in everybody's interest that we solve some of these problems.
Terrific. And you're developing some models that we'll be tracking to do that. Andrea, income, wealth, economic mobility, strong institutions.
What I was going to say is just listening to this panel gives me enormous optimism, even given the unprecedented challenges we're all facing. And it really speaks to the advances in both knowledge and technology and strategy that make new solutions that integrate and target possible. I want to add one other point, which was a question in the Q&A about how you know about trust. And because that's so critical. And I just want to share a short story, which is when we were testing children's savings accounts 20 years ago, very generous matches and everything. We did a pilot in Arkansas and nobody signed up. Not one person signed up their child. They didn't do it because the person who was selling was unknown in that community. The minute we changed that person to someone in the community, because everybody thought it was too good to be true, we had a full group and one of the highest performing savings groups in the country. So how we find those key trusted folks to help us do things that haven't been done in communities before to build wealth is what we need to do.
Great, great. And Damien, if you can take it home just with some wrap ups about how this becomes a national phenomena, like you said, everybody competing to get capital to these people in these places.
Let's make a lot of money betting on America. Let's make money betting on the working class. Data, goals, and tools. We have a lot of information at our disposal. The information is shared widely. It points a bright light on working class people, working class places. We have goals that I think meet the moment in terms of creating jobs for working class people in working class places and seeing that employees are centered and receive better benefits because it's good for the enterprise. So the clarity of those goals and the specificity meets the moment and helps drive toward betting on America and making money on working class people, working class places. And finally, in terms of the tools, our theory of change says you need capital plus services to make impact. And I think we're going to see more enthusiasm for smart people to invest their retirement and other dollars into strategies that visibly support working class people and working class places. That is the opportunity, and I'm very excited about it.
Well, that's terrific, and I think you've just clarified this playbook in a sense, because capital is and how that gets deployed is one part of it, and services, as we've heard here, is another part of it, and they're both necessary, and so everybody's plays are welcome. And I think as the other takeaway that we'll try to round up on Friday in the story is what you all have commented on, which is how these things can fit together into kind of a self-reinforcing ecosystem and a virtuous circle, as you mentioned, Damien. So thank you all guests, and thank you everybody who's joined here. Thanks to all the questions in the chat. We'll round it up, as I say, on Friday. We'll have a replay of the video, share it with your friends, share the link to the film, which I just put in the chat, and add your play to the playbook. So see you next time.